Welcome to the discussion on renewals. And there are two parts to this series. And this video is explaining or will explain about why renewals is so important, or considering renewals is so important. We're going to talk about something that fundamentally drives and determines your company's value. And that again is a customer renewal process. I'm going to show you why this is not just an operational detail. It's potentially the difference between a great exit and a mediocre one. Let me start with a story I've observed play out multiple times. Now, a company is preparing for acquisition. The revenue growth, they look strong. The CFO is confident. They're expecting a valuation around 10x ARR. And then the buyer's due diligence team, they dig into the renewal rates. They discover that gross revenue retention is 78%. Net revenue retention is 85%. Suddenly the valuation drops to 6x ARR and the founders are shocked. They ask, but we are growing 60% year over year. Why does retention matter so much? And here's why. The buyers, they are not buying your current revenue, they're buying your future cash flows. And if customers are leaving at those high rates, the future cash flows are much less valuable. I've observed that every percentage point of gross revenue retention can impact valuation by 0.5 to 2x ARR multiple. Yeah, you heard me right. 0.5 to 2x multiple. And that's not a small number. For a company doing $50 million in ARR, improving gross retention rate from 80 to 90%, it could mean the difference between $300 million exit and a $450 million exit. And that's a $150 million swing in value creation just from better renewals. So let me explain why renewals have such an outsized impact on valuation. And the first thing you have to consider is that renewals, they reveal the truth about your business. New bookings can hide problems. You can grow by spending more on sales and on marketing. You can offer those aggressive discounts. You can sign customers who are not really a good fit. But the renewals, they tell you something else. Renewals are when customers, they vote with their wallets on whether your product actually delivers value. I worked with a company that was growing bookings at 80% year over year. They looked fantastic on paper. But when we analyzed the renewals, we discovered that only 68% of the customer base were renewing after the first year of operation. The company was signing a lot of new customers, but they were not sticking around. And that is a fundamentally broken business. And the buyers, they see right through it. So when a buyer looks at your renewal rates, they're asking, does this company actually create value for customers? Can I rely on this revenue stream? Or am I buying a customer acquisition machine that needs constant feeding just to stay flat? Second, the renewals, they determine the leverage in your business model. And here's what I mean by leverage. If you have 90% GRR and every dollar of new bookings, they add to your base. Let's say you close $10 million in new business this year and you retain 90% the next year, you start with $9 million from those customers. Now you close another $10 million and now you have $19 million. So if you imagine you have 70% GRR now, you're on a treadmill. You close $10 million next year, you only have $7 million left. Now you need to close another $3 million just to replace what churned, plus another $10 million to grow. You're working so much harder for the same outcome. I've observed that buyers, they value high retention businesses at massive premiums simply because they understand this leverage. A business with 95% gross retention rate, they compound beautifully. A business with 75% gross retention rate is exhausting to operate and difficult to scale profitably. The third component of it is the renewals impact every other metric that the buyers care about. Let's walk through some. So there's a CAC payback period, which is if the customers are churning, let's say after 18 months, but your CAC payback is 14 months, you're barely breaking even. If customers, they stay for 5 years, the same 14-month payback looks awesome, looks fantastic. However, the buyers, they calculate payback assuming your historical retention rate is lower, then your economics might look terrible. You look at the LTV to CAC ratio, this is entirely driven by retention. If customers stay twice as long, your LTV roughly doubles. And I've observed companies with similar CAC but dramatically different valuations. Why? Because one has 90% retention and the other has 75% retention. And the LTV difference is enormous. Now, look at the growth efficiency, the magic number, the rule of 40 that you have heard. All of these metrics, they improve dramatically with better retention. Why? Because you're not spending sales and marketing dollars to replace the churn revenue. every dollar that goes to actual growth instead of backfilling the losses. So here's an example of how this might play out in an acquisition. I was advising actually in a company in an M&A process, and they had two competing offers, and buyer A, they were offering 8x ARR, a very solid multiple, whereas buyer B, they said, okay, we'll give you 10x ARR, but only if the company could prove that the gross retention ratio would stay above 88% post-acquisition. The company's trailing GRR was 86%. It is close, but not quite 88. So we dug into the data and found that recent cohorts were performing better, and they had made product improvements, and they had tightened the ideal customer profile that they were targeting. And so the last 2 quarters showed 90% GRR. We presented this cohort analysis to buyer B, proved that the business was improving, and they agreed to the 10x multiple. Now the 2x difference in multiple from 8x to 10x was worth $40 million on a $200 million valuation. All of this driven by proving that the renewals were strong and improving. Now let me explain how buyers think about renewal rates during diligence, because understanding this will help. It will help you prepare your business better. Buyers look at renewal rates by cohort. They want to have answers to several questions. What percentage of customers you signed in 22 will renew in 2023? What percentage of 2023 customers are renewing in 2024? They're looking for trends. Are renewals improving or are they going down? If your overall GRR is 85%, but your recent cohorts are at 80%, that's a red flag. It suggests that the retention is getting worse as you scale. So the buyers, they analyze renewals by customer segment as well. Which segments renew well? Which segments churn? If your enterprise customers are renewing at 95%, but your SMB customers, they churn at 40%, the buyers will discount the value of your SMB revenue. They might even exclude it entirely from the valuation model because it's not reliable. It's not recurring revenue per se. It's highly volatile. The buyers, they stress test your retention assumptions, and they will ask questions. What happens if the retention drops by 5 percentage points? What happens if your best customer segment, they start churning more? They will model those downside scenarios because they want to understand the risk that they are assuming. If your valuation depends on maintaining 90% gross retention ratio, and the buyer thinks that there's a good chance it drops to 85%, they will discount the price accordingly. I've observed that companies with strong renewal operations and data, they get better valuations because buyers' confidence in the data and in the sustainability of the revenue, they increase fourfold. Companies with weak renewal visibility, they get discounted heavily because the buyers are assuming the worst. So here's what a strong renewal operation will look like to a buyer. 1, you can show renewal rates by cohort. You show it by segment. You show it by product. You can go back several years and the data is clean and auditable. 2, you have a formal renewal process with very clear ownership, tracking, metrics. The renewals don't just happen, they are managed. 3, you predict the future renewals with reasonable accuracy. You know which customers are at risk and what you're going to do about it. You have leading indicators of renewal health. You look at product usage metrics, you look at customer health scores, you look at the support ticket trends, and you use them to intervene before the customers churn. 5, your renewals are improving over time. You show that, you prove that. Your recent cohorts, they perform better than older cohorts because you are learning, improving, adapting. And when your buyers start seeing this, they start to think about paying those premium multiples. However, when they don't see this, when the renewal data is messy, when there's no formal process, when the CEO cannot explain why the retention is what it is, they discount heavily. So let me give you some simple math, a very high level on how this impacts exit value. I'm going to use a hypothetical $50 million ARR company. Scenario A, 80% GRR, they will value it as 6x ARR, which is $300 million. B, 85%, they'll value at 8x, $400 million exit. And C, 90% GRR, valued at 10x, which is $500 million exit. The 10% point spread of GRR improvement from 80 to 90% is worth $200 million in exit value. I've observed that going from 80 to 90% alone is a high leverage point for valuation discussions between the founders and the buyer. This is why as CFO, you need to deeply care about the renewals. It is not just an operational metric. It is not just a customer success problem. They're a fundamental driver of enterprise value, and improving those renewal rates is one of the highest ROI activities you can invest in as you prepare for an exit. So here's what I would recommend every CFO to do. 1, understand your renewal rates deeply. Not just your overall number, no, but understand it by cohort, by segment, by product. Know which customers renew and which don't. 2, make the renewal rate improvement a board level priority. Set the targets, track the progress, and then invest in the systems and the processes needed to improve the retention. 3, build the renewal operations and analytics that buyers want to see. Don't wait until you get to due diligence phase. Build it now so you can demonstrate years of strong improving retention. 4, model the valuation impact. Show your CEO and the board what retention improvement is worth in exit value terms. Make it tangible. I've observed that companies that take renewals seriously and the operational component seriously, they build rigorous renewal operations and drive continuous improvement. They create literally tens or hundreds of millions of dollars in additional enterprise value. And customers that treat renewals as more of an afterthought, they leave a lot of money, a lot of value on the table. So next week, what we'll do is we'll get tactical. I'll walk you through the operational framework you need to ensure that the renewals don't fall through a leaky bucket. We'll cover the systems, we'll cover the processes, what the accountability structures are that high-performing companies use to drive this retention and to create this valuation upside. I'll see you in the next episode. Take care. Thank you.